Welcome to the Festival of Entrepreneurs, recorded live at the NEC in Birmingham. Over the next few minutes, you'll hear from some of the most incredible founders, investors, and business leaders who joined us this year.
So this is about how ambitious founders can leverage debt and equity. It's about finding deals, the valuation game, about getting deals done. And it's kind of like, it's really going now behind the curtains and saying, well, okay, you want to do this, but you want to find out what the warts and all is, or you want to find out is it worthwhile doing it for real. Okay, so again, I appreciate some of the people who've joined in the room, but where we're starting off from is those people looking to buy businesses, those people who've already bought and sold businesses, and some people here looking to sell businesses and maybe invest in acquisitions as well. So same people in the panel. We've got Charlie, we've got Clive and Steve, and these are experienced, straight talking business owners who have bought, built, sold, and now even brokering business sales themselves. So I'm gonna kick this straight off then. It's it's easy, this stuff. Well, we said it wasn't easy. Well, is the hardest part finding the deals? I mean, how do you think is the best approach of trying to find deals? You want to kick that off, Charlie?
Yeah, certainly. I know Clive and Steve got different methodologies to me, as we previously discussed. I think their methodologies are great, by the way. It's just my own personal methodology is to become, I hate to be afraid to be very heard Daniel Priestley say this a lot, becoming a key person of influence and just be an industry figurehead. And when I was in the haulage space, hosting retraining vehicle recovery, I was at all the shows, I was doing the panels and the speeches, I was getting to know the other owners, and even acquisitions is a long-term game. It's not going to just happen overnight. I remember one deal I bought, really good big recovery business. I told the owner 4 years prior, just because I bumped into a station services, I went, oh, hang on, I'd love to play business one day. And 4 years later, when he was ready, he came to me. Which is great. And now with Vamos, you probably see me spew a lot of stuff online, talk about MMA and the subject, hence why I'm here today, because part of my client acquisition, or in your case, deal acquisition, I believe should become like a magnet. It should be attracted towards you, and if you put yourself in the right position, in the right places, people will present you offers. So if you want to be more proactive, you do what Clive and Steve would probably recommend, and do cold outreaches, mail campaigns, cold calling. In fact, I once door knocked on a company, stuck my big fat head in there, and it's supposed to sell. And I was 22, my first full leverage buyout. So, all methods work. Just pick a couple and keep doing it.
Thank you for that, Charlie. So, I think there's probably a theme going across this actual panel. Is you're all key KPIs, key persons of influence. So, Steve, tell us about your journey of how you've managed to get your sellers to come to you, or you go to them.
Yeah, I do pretty much all cold outreach. So I think it starts off with knowing which sector you want to buy in. So at the very, very beginning, I was the guy sat on the website, said the listings, just kind of hitting refresh, hoping that my dream business was going to come onto the listing, and then that they were going to pick me and I was going to get a great valuation and it was all going to be perfect. It was all very passive, and waiting for a website to be a dream to come to you is probably not really a great way to approach these things. So it was because I was trying to buy into really different sectors and I didn't know what I wanted to do. When I decided a specific sub-niche of manufacturing, I could then go off and buy the data from something that scrapes for your company's house with the market sector, the size of the business, the number of employees, even the age of the owner. So I bought the data of 1,000 companies, spent some time just manually cleansing it. Are these the type of companies I want to buy? Are they too big? Are they too small? Are they in the right geography? Is the owner of the right age that they might be looking to retire? They're the type that I deliberately target. So I started with this huge data set that I manually cleansed. I've now got it down to a pretty decent, almost like my own mini CRM of my subsector of manufacturing that I target. And then I just send them letters in post. So I, obviously in language that's specific to my industry, knowing that people are of the age that might be looking to retire and that I'm a relevant person. And I'm going to nick what Charlie said about being a key person of influence. So I make quite a lot of noise on LinkedIn about what I've been doing and share the journey of how we've transformed manufacturers over time post-acquisition. So when people do look you up online, and they'll look you up on Companies House, they'll try and find your digital footprint and check you out. So I made sure that all that stuff was up to date. So when my letters were landing, there was actually some credibility behind what I do. On top of that, my industry, as probably most are, they're quite small and there's a small number of key players. So I get to know the recruitment companies, because when someone puts their CV online because their boss has just told them they're going to retire next year, the recruiters ring me and say, hey, the business might be for sale in a year's time. When the machinery people will try and sell new machines into these guys, and the owner says, no, I'm not going to buy any new machines for a few years because I'm going to be retired soon. Same thing, you get the machinery guys to call me, and you start to get leads through the informal network of the industry. It's probably not unique to injection molding. I'm sure there's plenty of those industries where it's a small number of players who really control a lot of their decisions. But yeah, deliberate outreach, I think, is my main thing, of deliberately trying to be visible and having my letter land on the man. When it does, they know who I am.
I've got to say, I've not enough Steve's LinkedIn updates. I know nothing about injection moulding. There's like day 128 of post-acquisition. It gives a full synopsis of the updates, the bonds and the efficiencies. And if you really like business, follow Steve's post, which they are for.
Yeah, that's fair enough. I mean, if you do go on LinkedIn and look up Steve Lawrence, you will see this. It's quite a good story to journey to unfold. He's building his book in advance. You can see it happening. So, Clive, I know that you're talking from a perspective of doing it for yourself. You're also helping other people to do it. What kind of methodologies have you used that you found to be more likely to succeed than others?
Well, first thing to say is you should tell everyone, quite frankly, what you're doing. So I think if you go LinkedIn, I didn't mention it, but who's on LinkedIn? Well, okay, so all of us, the first thing you should do, to be investing or acquiring businesses, is put on there that you're in the acquisition space. You're actually a business investor as well as just a business owner. And you'd be surprised, there are opportunities that will come to you. I get probably now 6 to 8 a day, people reaching out to me about acquisitions in various forms, or investments in various forms. People know me. Now, I don't, obviously, I'm not looking for a lot of the opportunities to come my way. But what I do is I have a network and I pass them out. And guess what happens when you pass things out and you help people on their journey? They tend to pass things back when they get the opportunities themselves. So there's that for a start of. And then in terms of actually outreach, I think personally, there's a number of different ways. I mean, obviously, most business owners think that brokers are the way in which they're going to go and sell their business. So they think they're going to advertise their business, they're going to do this once, right? They're going to go and sell their business through a business broker, they're going to list it. And Charlie is the exception, one of the exceptions, but most of the big brokerages, the top two for 2024, they had over 60,000 businesses listed across the two largest brokers in the UK. Again, I'm going to be on to you. How many of those businesses do you think actually sold? I want to come to Oksana. Go on then, call me a number, Oksana. Percentage-wise, 50% sold. Anybody think it's lower than that? Go on then, sir. 10. Anybody else? 15. And then we got 5. My word, it's as if he knew. 3007. So in actual fact, it was about 5% of businesses actually sell. So basically, the majority don't, and there's a reason for that, because they're quite often overpriced. So they're going to be basically listed at 5%, not in the crowd. Somebody who's got experience of this, they're pricing not very high. So you're going to have to go out, I would suggest, if you're serious about acquisitions, and you're going to have to originate your own deals. Okay, or you could find a very good broker to work with. You find somebody that's very niche. So we've seen there's a lot of boutique brokers that are setting up in particular niches. So I know one very good one that's in the medical space, that he will bring you great deals in the medical space if you were looking in the medical space. Another one that works in the printing space. So all these different things, there's different niche brokers. But you're probably going to have to go out and deal originators. I think Steve's approach to getting very hyper niche is really smart because he allows you to then go and in search of very specifically criteria. And then, yeah, I mean, I've done the reach out in terms of letters, always handwrite the envelope, always hand sign the envelope. I never get them framed because people think if they see a framed envelope, what do you think? Ladies and gentlemen, you think it's a business letter, right? Okay, you want it. How many people write to you with a personally addressed envelope? Not many, I would suggest. So therefore, you get more that typically opened. My daughter's got particularly good at signing my signature, by the way. She does all the writing apart from the she's far better at writing than me. That worries me in one sense, but in another sense, it's pretty helpful. But she's, you know, we always handwrite the letters. We also employ a VA to go and actually find out the facts about the business, do research on the businesses on our list. And when we find something that's really key, maybe an award or something of that nature, we make a mention of it in the letter. We make it very personal because this is a big decision for them, and if it's for us, it's a big important part of our process. We want to connect with the right businesses on the right level, and we want them to know that we actually do care about the business we buy. That helps us. Also with the building rapport from the get-go that we are the right people and safe there elsewhere in their business. And then I use LinkedIn an awful lot. Do I send very much complicated? No, not really. I find out people that probably own businesses that I might want to buy, and I very simply reach out to them with a personal message saying, as a professional within this sector, manufacturing sector, the digital marketing sector or whatever, as somebody I respect as a professional in the sector, I'd like to connect with you because I'm actually looking to acquire businesses in this space. What actually happens is, I've now found, is that 9 out of 10 people that respond to me actually connect with me. The reason they do so is because they're looking to sell a business. So the next stage is a lot easier. So that's just an example of some of the things that I do to connect with the right businesses.
Thank you, Clive. Just before we want to next say, this to cover up brokers, I think it's fair to say that there's a culture inside of acquisitions where business brokers have got a bit of a bad reputation, and in some circumstances rightly so, because what they've got is they're overpriced. They've not done their best to make sales. I think it's only fair to give the business transfer specialists in the room the last word on this, because I think it's you should share with how it should be done, so that when people are looking at the business transfer people or business brokers, they can look out for people in your kind of space and your kind of mindset. So Charlie, can give us last bit on this?
Yeah, interesting. So similar to what Clive said about the success rate of setting a business with the traditional biggest brokers in the country, one in particular, KBS, I referenced their last year financial report. They turned over 160 million on their business sales side. 80% of that revenue was generated from engagement fees, and 20% was actually generated from actually selling a business. So essentially what the traditional old school model was, you know, let's say Steve's business, 6 million revenue, I say it's worth 30 million. Obviously, I know it's not, all right, not yet. But they would say a high valuation in order for someone like Steve to pay him £30,000 to list their business for a year, wait a year for the contract to expire, ask for another £30,000, they keep them on this Ferris wheel because they're more interested in the recurring revenue model than actually selling a business. Now, I hate to plug in the Vamos by brokerage, but we are the anti-KBS model, where we sell businesses within 90 days, and we do have a 100% success rate of doing that. It's why, you know, we've grown really fast in last year, because we do a good, honest job. Now, there are other brokers who also do a good, honest job. I'm not saying I'm the only one, but I'd say it's a new generation of brokers. They've looked for years, over decades, and thought, these bunch of such and suches, they're not doing it right. And I've been being a business buyer and seller for 14 years. I used to inquire about business with other brokerages, and they'll never get back to me. And I told them, I'm one of the biggest buyers in this space. Why on earth I'm getting back to me? So we are trying to bring the industry into good repute, deal by deal. And there's other brokers, like Clive said, who specialise in certain industries. We're sector agnostic. We do anything from 1 million to 50 million. And one of my principles, my guiding principles is, would I buy it? If I wouldn't, I'm going to take on as fine, unfortunately. So yeah, with brokers as such, some of the bad reputation is completely warranted. It's an unregulated industry with ex-estate agents, car salesmen, or fresh uni grads, people who've never ran a business. They've had the hardship of making payroll at the end of the month when they've only got a tenner in the bank account. So yeah, that's why some do get that rep.
Thank you for that.
I think it might be quite telling to you, Charlie, just how the decent, honest brokers would ordinarily charge.
So traditionally, with the larger business brokers, they would do a valuation in only qualified to, or they should not be doing that. And they'll figure out how big the business is, how much cash you've got in the bank, and go, I'm going to charge you what they think they can get away with. So we're quite transparent with our fees. We're £10,000 up front and 3% once sold. And there's different models of pricing. Some people charge the 30 grand for a year's contract, rinse and repeat. I found one recently. He's quite a famous business broker because one of his clients came to me because he did a good job. They charged £20,000 up front, then 2.5 grand a month, and there's no incentivisation there to actually sell the business. You just keep them on the Ferris wheel, month by month payment. And the client, who's now my client, went 10 months and had no inquiries with that other broker. He's been with me now 2 or 3 weeks, so he's had 14 buyers conversations. So do if you're going to sell a business, whether it's me or whoever it may be, one, ask them, will they back up the valuation in the contract? You know, if you think it's worth that, would you put that in the contract? Which I'm always happy to. What is their true incentivisation? So are they getting most of their money on completion? Which I do. To be honest with you, because when I first started, I didn't take any money up front because I was new. I just used to do commission only. But as I realised I'm one of the best in the country now, I need to charge up front a little bit. Plus I've got a team now around me and whatnot. So we do charge a small fee, which is considerably lower than other brokers out there.
Thank you, Charlie. Just so we're going to keep this moving on there because I think we're otherwise going to stay in one location. So we earlier talked about valuations, and I think we've pretty much covered how valuations work. Quite a few people have stayed in here. So we're going to move on to deal structures. So it's not an imagination, but a lot of people do anticipate that when they're buying a business, they have to use all their own money, and they have to pay all the money up front. So, is that fair to say, Clive? Is you have to use all your own money and pay all the money up front?
No, I mean, there are different types of deals, and we've talked about, pound out deals. And obviously Charlie made the very wise point that, quite frankly, there's only people actually advocate buying a business for a pound, and it's quite frankly a world of fame. A world of wasted effort and energy as well. So in terms of obviously the world about structuring a deal, what you need to basically do is have a sensible approach to, you're going to have to put some money into the deal or something as equity or essentially up against the deal. So if you normally own a business, may well be you can leverage the business you've got in order to put your skin in the game. But if you're a banker, think written up on it, you're a financer. You're going to go and basically fund somebody to buy a business, and then we then have to have no risk in that situation. Yes, it is no, and that's the situation. But when you do this, and you maybe do your first deal, you can do a thing such as Steve has alluded to, which is it's now, because of the growing group that he's got to, his original investment is actually becomes a smaller portion of the actual overall value of the group. So this is a process of a means to an end. In terms of structuring deals, there are many different ways of structuring deals. Some of it maybe down to doing what you may have heard about just now, which is leveraged buyout, which is essentially taking some funds and ultimately getting those, utilising the business, the assets within the firm, and in order to leverage further finance. But there are other types of structure. You can go for things. So one deal I did in the States was actually an options agreement. So I actually did put no money in to that deal, but there was an option. And what I had to do was we had to hit certain marks, and if we hit certain marks, then automatically we became the beneficiary of a chunk of equity within that business. And in actual fact, we then got also a further option to buy an additional chunk of that business at a very much a premium price if we obviously have brought value to the deal. So there are many different ways. You may one thing we've got is consulting for equity. So this is where you bring your expertise to bear. You may earn an ongoing retainer from the business that you're working with in order to help them grow. But if you can give them a strategy to help them to grow, and you can raise that, then you can obviously obtain equity within that business in order to assist them and take a piece of the upside, as it were. So there's many different types of approach that you could take in order to gain equity within a business.
Thank you, Clive. I think so. Just so back to the audience. So consulting for equity is you own a small stake. You'll be given a small stake, for example, because you can demonstrate you can add value, and then potentially you are then a minority shareholder. Now, I work in finance for acquisitions, so when lenders look at this kind of opportunity, they say, well, who wants to buy the majority of the stake? And they say, well, I'm the minority shareholder, I now want to buy the rest of the business. And the lender would look at that person and say, well, what do you know about the business? Well, I've been working inside the business for a while. Now I know exactly how it works, know who the customers are, know how the team is, and how it all comes together. Will I lend money to the minority shareholders to buy a majority shareholder? Absolutely they will. Because you're not a guarantee, but you're kind of like considered to be better, knowledgeable, so you can start off with a small stake and then grow it into the acquisition of the majority share or even the 100% share of the business. So I just wanted to share that. So thank you for that, Clive. So in your circumstances, Steve, we talked about putting a small amount of money down. We don't even know the amount exactly. You talked about generate 20 to 30 times that investment so far, if you were to say it today, for example. But could you kind of like give an example of how a deal structure looked when you were doing it? So you bought a business, either the first or the second one. What did that look like in proportions?
So my first one was, like I mentioned, quite heavily leveraged, so multiplying our money against the business. So there's a few different finance products. There was an invoice finance facility where you borrow against the existing debtor book, which gets released on day one. And where it's a manufacturing business, which has got hard assets, we borrowed money, a loan, and that was then secured against the assets of the target business. So there is a quite common misconception, I think, that to get into acquisitions, you need to have millions of pounds in the bank and stuff like that, and that it isn't the case. That's not to say you can, as Clive was mentioning, turn up and just start milking a business from day one with no idea what you're doing. But there definitely are ways and different finance products to do it, and you can stack these together. So for me, there was a percentage of my own money that I put in. There was a chunk which was invoice finance of the letter book. There was then a chunk which was leveraged against the machinery in the business. And then the final bit that we've not spoken about is vendor finance, where the seller doesn't get all the money on day one, which is a very common mechanism that people put into deals. Sometimes it's because sellers want a massive valuation, and it's the only way to hit the number is to say, well, we'll pay you out of the profits of the business from the future, and you'll get that rather than on day one. But for me, it's a really good way to keep the seller honest, meaning if they're going to not take all the money on day one, it means they believe in the future of the business. They believe the business is going to be able to pay them for year 1, 2, and 3, for example, as part of the structure. So what you don't want to do is buy it, leverage it, take all the money out, give them 100%, and then on day one, the biggest customer goes and the seller knew that was going to happen, or the number one employee goes and sets up a competing shop around the corner and stuff like that. So idea of vendor finance is very common. I'd probably say, maybe Charlie can explain a bit more, but the majority of deals will contain a vendor finance element. And while it's useful from the cash flow perspective, meaning you don't have to raise as much money on the business because you can use the seller finance. For me, it's that strategic tool of, if this person believes that it's going to be able to pay them over 3 years, it definitely gives me confidence as a buyer. And if they won't, there's probably a reason why they won't do it. Is that consistent, Charlie, what you're seeing?
Yeah, very consistent. It's interesting, the lady back there who works at the family office was mentioning about private equity and capital deployed earlier. And something I've noticed recently, last year or two, is that private equity, traditional PE, is coming down a little bit. So they are competing a little bit with, you know, I say comment, but you know, the smaller, medium-sized enterprises who are looking to grow through acquisition. So, and I get this a lot of my clients. You know, we just sold a commercial PE company for £4 million, and there's all different buyers on the table. There are leverage buyers, there are trade buyers, and then there was the PE buyers. And whilst the PE buyers did have a structure, similar to what you said, they had a lot more capital up front to deploy it, to make it more favourable, you know, to the seller's opinion for your of quite more on day one. So I would say, if you are a leveraged buyer, not only should the structure be very sweet and convincing, you as a buyer have to be convincing, i.e. from that industry, or, you know, having a professional background, like Steve with his corporate manufacturing background, going to injection moulding. In fact, I think there's many Steves out there who try and buy injection moulding businesses nowadays. I've seen a couple. Yeah, it does convince the buyer that you're the right nurse. In fact, I speak to 50 to 100 wannabe business buyers a month. I give them just free advice because I didn't learn through a course or anything. I would recommend go acquisition masters or go get some formal training, because you are as much heartbreak and heartache as I did going through that journey. It's probably a lot more success. But I speak to a lot of business buyers, and a lot of them go, I'm an MA analysis at 19 years old, and I'm like, well, what's your niche? What's your industry? Because a seller's going to look at you and think you don't know what you're talking about. And also, it's quite detrimental to the business you're buying. If you don't understand the industry, you won't understand the supply chain, the average cost of doing that, correctly pricing the jobs, when quoting for work. You might undercut. And it only takes about 4 or 5 big mistakes for a business to go under. So I would say buy your niche in particular.
Thank you, Charlie. So I think that we're kind of coming towards the end of this conversation, but there are 2 key elements still to cover. I don't want to go into lots of specific details in each of them, but I think it's only fair that we do cover them, because one of the easiest things to do is say, well, I'll buy that business, and then you say, well, okay, we've got an idea where to get it, we've found out who it is, we think how much it's worth, and then comes the actual deal. But before we get to the deal, closing the deal, we have to do what's called due diligence. So it's fair to say that there's an element of questions that need to be asked, information that needs to be gained, and it can come from a variety of different angles. So could you give me an idea, Clive, what the kind of things that you see in due diligence, or what you would expect to see?
Yeah, so I mean, first and foremost, the things to do is when you enter a typical due diligence process, you've entered into the heads of terms, so you've probably got exclusivity period, and people think that that's when due diligence starts. I don't agree. I think due diligence starts really the first time you pick up and you get an interest in a business, and you need to start to collate as much information about it as possible. Yes, you need to look at the financial situation of the business, but you also need to look at the commercial side of the business. How does it operate? The digital footprints of the business. There's an awful lot of things in the world of digital now that tell us an awful lot about whether the business is worthwhile. We've got the lawyers I know in the audience. We've got obviously legal due diligence. Well, what is, ask the questions of the seller directly when you're in those seller meetings about to clarify. For example, do they own the premises in which they're in, or do they rent them, or what are the terms, or are they putting you through a personal property business, and all of these things. These are all things that you can do to go and actually do your own due diligence before you get into a formal process, at which point you'll be employing experts at great cost to you. So the more you've actually done the better. It also might also give you, you might have a situation where you come across something which is a bit of a game changer, and means that you don't actually end up getting into formal due diligence. And to give you an example of where that's the case, I actually had a deal that was actually referred to me by a broker actually before they marketed it, because they knew that I might be somebody that's interested in that deal, or I might know somebody that was. And they had this particular deal. And this particular business was an e-commerce business. And this particular business was a very successful e-commerce business. Well, sort of, you judge. It was making 30,000 from their profit every single month. It was doing okay, right? And so this business was there, and they had a bit of debt. And the bit of debt they had, I was thinking, that's not very much debt relative to what they're actually doing. So the amount of debt that they had was just over 100 grand. So it was like a business that could definitely be one that I was potentially interested in acquiring. Not least of all because I've got a digital marketing company, and I've got people within my company that know how to blow these things up. Anyway, by doing that, what I also did was I passed it to one of my guys and said, he's the guy that's the best in terms of e-com. I kicked it to him. I asked him to have a look over it on what he saw. And his, I won't tell you his initial expletives because they were like, well, let's just say he was joyous in relation to the opportunity that might exist. And then he came back to me, he said about half an hour later, cancel all of that, because he then done some digging beneath. So for example, this particular business, which there's obviously trying not to give it away, but basically they had 250,000 Instagram followers. Fantastic. Turns out, on my guy's basis, that he actually bought those econ followers, and everything, all the comments on there were scam, and all this sort of stuff. So from a business that looks on the face of it like being a fantastic opportunity, within an hour, we'd actually able to rule out by some just simple due diligence, I would call it, established that it was a business that he should sit with a bar fold. So I think in terms of due diligence, it's multifaceted. It's very, you need to get, when you certainly get your thinking and you're actually looking to buy a business and you've made offers and you have them accepted, it's a very deep process. You need to have the right experts, the right lawyers, the right accountants, the right commercial people to be able to go and give that due diligence. Another big one, culture. Your business, it needs to match your culture. It's not to say that somebody's culture is really worse than yours, but at the end of the day, if you are a business owner and you try to, I'll tell you now, you try and integrate a business where the culture is not right, and it's completely different to yours, it's pain. So yeah, those sort of things are the sort of things that we need to cover off in terms of due diligence.
Thank you, Clive. And just mindful of time, moving on. So, and just so you know, there's a certain person in front of this room who is very strong on diligence from a legal perspective. He's in the blue dress, so if you do want to speak to you, certainly can. So I'm going to come on now to the deal's done. Okay, you've signed the documents. You're now the business owner. But this is the easy part, obviously, isn't it, Steve? So as a recent acquirer of 5 enterprises, some shares, some assets, of course, you just switched on the lights on each of these and everything, just money comes rolling, is that right?
Yeah, I came here in my private jet today and I'm off to the beach tomorrow. Yeah, exactly. No, unfortunately, it doesn't work like that. I think it's really easy to not think about life after the deal because you get so into due diligence and legal questions and just trying to make it happen, especially the first time now when you've said you're going to do it and it's quite a long slog to get over the line. But yeah, you quickly realise that on the first day after acquisition, you've got debt in your name, you've got employees who now you've got a duty to, and you've got a financial model that you've put together about how this is going to work. But you've just come into a business where you've got no gut feel, you've got no intuition, the staff have got no reason to trust you or know that you know what you're doing. So there's quite, especially in manufacturing, where often acquisition means the factory's been moved or closed or merged or something like that. So yeah, I think the job starts at completion. It doesn't actually, yeah, it would be really nice to think that you could just do the legals and then move on, but that's not quite how it works. I think going back just very quickly on due diligence, during my first deal, I felt like a bit of a passenger through the due diligence because the lawyers and the finance people, they know the legal steps required to buy a company, and they're happy to do that, and they take the lead because obviously they're the right people to do that. But you need to develop what your own due diligence looks like. What type of company, what type of seller, what type of industry do you want to go in? So I was kind of swept along with all of the legal terms and clauses and things like that. And then they're there and they get paid and they disappear, but you're left holding the can on a business that's now got debt and no people, and you may not understand the numbers on day one. So yeah, I would say have your own criteria for what a deal looks like alongside. It's a given that it needs to be compliant and it needs to have paid its taxes and it needs to be no historical liabilities that are going to come out and from the past. So that's all a given. Their job's to find that stuff. It's yours to come up with a thesis of the type of company and then make sure you're buying what you think you're buying.
Thank you. So, I'm going to summarise for the moment, and then I'm going to take some questions that may come, because then we're going to be thrown out, I'm sure, because we've held on to the stage for a bit longer. So, in summary then, so what we've talked about today in this part of the afternoon is to talk about finding deals and about how they could be structured, how they could be funded, how it can be looked at diligence, and also the hard yards doesn't end with the deal being done. That's kind of step one. So in essence then, earlier part in the afternoon, if you were there, it's a great potential thing to do. I think we agreed upon that. I think now in the reality of things is it ain't easy, but the rewards are potentially hard. So it's about, are you going to be there and do you want to do it? And I think it's like a lot of people say, if it was easy, everybody would do it. And the people that do it well, the ones that stay the course. And amongst us, we have people who can absolutely demonstrate they've stayed the course. So I'd like to open the floor now to questions on anything about doing deals, why you do them, how you've done them, what kind of things you've faced, what kind of successes or even failures that you had. So anybody would like to kick off a question? Okay, thank you.
Hello, it's me again. So clearly we know where the UK is at the moment. Next budget's coming out in October. What's everyone's views in terms of what other economies are doing? Are you guys looking abroad? Are you staying locally? What's your pieces for staying here, if so?
So obviously currently with the UK government, there's quite active business. Obviously a lot of taxation changes with inheritance tax, business asset disposal league. That's actually encouraged a lot of people to speed up the selling of their business when they maybe had a 5 or 10 year plan. That might be shortened to a year or 2 year plan. Now, with the autumn budget, which actually I think come out in November now, weirdly enough, for some strange reason, who knows what good old Rachel is going to announce. Seems like she's going to be attacking the property market more so. Thank God, I sold my residential last year. But with other countries, and I'm just using the US for example, they do encourage business, they do encourage acquisitions. Now, I got offered yesterday to set up business brokerage in America, in Texas in particular, because the different states have different regulations around that. But with America in general, they're more accustomed to what Steve said about vendor finance and seller equity, so they're more accustomed to third consideration. Their government has a program called the SBA 7A loan, which encourages lending towards acquisitions. So that's a great market. In fact, one of my friends has the biggest business brokerages in America, under £500,000 of listings, and you see post the listing, and it actually has the deal laid out in front of you. 10% down, seller financing with a 6% interest rate over 15 years. And I'm like, that is brilliant. You know, that is flipping fantastic. And then you've got other emerging economies like Dubai, the UAE, that obviously the low taxation jurisdictions, and I think they recently announced corporation tax. So it thrives for businesses, particularly startups or high growth models in there. But in terms of acquisitions, the country I'd operate in, if I had to reset the clock, would be the American market currently.
Okay, well, thank you for that, Charlie. I think it's fair to say we need to get out of here before we get thrown out of here, because So I just want to say to everybody, for me to let it go, thank you very much for your input, Seth. We really appreciate it. And I just want to say to the audience that these guys will all be outside. Charlie's got a stand just over there. We've got a stand just over there for his equipment, so Bama's going to talk to us. I will go Clive and Steve quickly, because they're probably going lots of other things now. Steve's got a bit of a journey back to the southeast. So otherwise, I just want to say thank you very much for staying with us, and I hope we've added some value to your thoughts and your ideas about acquisitions and how they could help you. Thanks all.
Thanks for watching this special episode from the Festival of Entrepreneurs. Our mission is simple: to help founders and business owners grow faster, think bigger, and take action. And if you were part of the event, thank you for joining us and being part of the community. And if you missed it, don't worry. We'll be back with even more ideas, inspiration, and opportunities to help you take your business to the next level. You can find out more and register for future events at festivalofentrepreneurs.co.uk.